It's 11:47 p.m., and you're lying in bed scrolling Zillow again. You've got a listing pulled up for $112,000. 3-bed, 2-bath, decal yard. Your thumb hovers over the mortgage calculator because some part of you needs to know the number even though you already know it's going to hurt. You do the math. $2,193 a month. Then you check your rent. $1,650. And for a second your brain goes quiet because renting suddenly doesn't feel like throwing money away. It feels like the smart move. That scares you because your uncle, your coworker, your dad at Thanksgiving, they all say the same thing. Renting is throwing money away. So in this video, we're doing the actual math, not the internet slogan version. The real version, with real numbers, so you can figure out which one is actually smarter for you. If you've ever stared at a mortgage calculator at midnight wondering if you're behind in life, hit subscribe to Money with Rabby, and give this a thumbs up if this helps. Let's start with the phrase that causes the most bad decisions in personal finance. Rent is money you'll never see again. It sounds true. It feels true. But it's incomplete. Because buying a home also involves money you'll never see again. Property taxes, insurance, maintenance, interest. Now you might be thinking, okay, but at least with a house I end up owning something. Fair. And that matters. But owning something isn't the same as coming out ahead financially. Those are two different questions, and most people accidentally answer one while thinking they answer the other. So let's separate emotion from math for a second. Here's the real cost of that $412,000 house. Assume a 7% mortgage rate, 20% down, so $82,400 up front. Your monthly payment is $2,193. Add property tax around $340 a month, insurance around $120, and maintenance, which experts estimate at roughly 1% of home value per year. That's another $343 a month. Total real monthly cost, not $2,193. Closer to $2,996. Now compare that to renting the equivalent home for $1,650. That's a $1,346 monthly gap. Now you might be thinking, okay, but the house is building equity. The rent is just gone. Also fair. Let's actually test that. And this time, let's test it properly. Because here's what most rent versus buy videos get wrong. They only count the monthly savings. They forget that if you're renting, you're not tying up $82,400 in a down payment either. That money can be invested too. So if you invest both the $1,346 monthly gap and the $82,400 down payment into a broad index fund, at a 7% average return, after 10 years that grows to roughly $400,000. Meanwhile, the house, after 10 years, assuming 4% annual appreciation, is worth around $610,000. Subtract the remaining mortgage balance of roughly $283,000, and your equity is around $327,000. So the house gives you $327,000. The renter investor gives you $400,000. Renting actually wins here by about $73,000. But that $327,000 in home equity isn't the same as $327,000 in your pocket. And this is the part almost nobody accounts for. Selling a house costs money. Real estate agent commissions typically run 5 to 6% of the sale price. On a $610,000 home, that's up to $36,600 gone before you see a dime. Add closing costs on the sale, maybe another $6,000, plus whatever repairs the buyer's inspection turns up. So that $327,000 in equity can shrink to something closer to $280,000 once you actually sell. Here's why this matters so much. If you buy a house and move again in 3 years, you eat the buying closing costs, the selling closing costs, and the agent commission, all while barely making a dent in the mortgage principal, since early payments go mostly toward interest. Which means the house only becomes a genuinely good investment once you've owned it long enough to absorb those transaction costs and let principal paydown catch up. That's usually 5 to 7 years, not 2 or 3. In year 1 alone, of the roughly $26,300 you pay toward that mortgage, only about $3,350 actually reduces what you owe. The other $22,950 is interest, money that builds you nothing. So appreciation on paper, my house is worth more now, doesn't automatically mean you made money. It means you made money if you stayed long enough for the math to work in your favor. But here's the part nobody puts on either side of the spreadsheet. That $73,000 renting advantage only shows up if the renter actually invests the gap every single month. And most people don't. They rent the cheaper place, then quietly absorb the difference into takeout, subscriptions, and a slightly nicer car. This is where a mortgage does something sneaky. It forces the saving. You don't get a choice about paying it. Part of that payment builds equity whether you feel disciplined that month or not. The bank basically saves for you. So when people say homeowners build more wealth than renters, that's true. But be careful with that stat, because it's not proof that houses are magic. Homeowners also tend to have higher incomes, more stable jobs, and enough savings to afford a down payment in the first place. Some of that wealth gap existed before they ever bought anything. The house gets credit that partially belongs to the person. Which means the real question isn't, does buying build wealth? It's, would you actually invest the difference if you rented instead? If the honest answer is no, a mortgage's forced discipline might be worth more to you than the math on paper suggests. Let me tell you about a woman named Denise. Denise was 29, living in Ohio, paying $1,200 a month in rent. Everyone in her family told her she was wasting money. So she almost bought a $260,000 house just to stop feeling behind. But she ran the numbers first. The real ones. Taxes, insurance, maintenance, opportunity cost, all of it. And she realized owning that house would have cost her almost $700 more per month than renting, with no guarantee the market would even move in her favor over the next few years. Here's the part that actually mattered though. Denise knew herself. She already had a habit of auto-investing every paycheck, so she trusted herself to keep investing the gap instead of spending it. She decided to keep renting and invest the difference, down payment included. For years later, she told me something that stuck with me. I thought owning a house would make me feel like an adult. But watching that account grow every month, that's what actually did it. It wasn't the house. It was the math finally making sense, even if it only won by a little. Now, I want to be careful here, because this isn't, renting is always better, or buying is always better. Buying tends to win when you're staying put for a long time, usually 7 years or more, because upfront closing costs need time to be worth it. Buying also wins in markets where rent is unusually high compared to home prices. Renting tends to win when you move often, when maintenance costs would stretch your budget thin, or when the local price-to-rent ratio is unusually high, meaning homes cost way more than renting the same space would. There's a simple way to check this for your own city. Take the home price, divided by the annual rent for a similar place. If that number is under 15, buying usually makes more sense. If it's over 20, renting usually wins, and the difference, down payment included, should go into investments instead. For that $412,000 house renting at $1,650 a month, annual rent is $19,800. Divide $412,000 by $19,800, and you get almost 21. That number alone tells you renting is likely the stronger financial move in that specific case, even though it's the one that feels less like progress. Here's the deeper problem though. This isn't really a math conversation for most people. It's an identity conversation. Buying a house feels like proof you made it. Renting feels like standing still. But standing still while your money compounds in the background isn't standing still. It's just quiet. And quiet doesn't get you a Thanksgiving speech from your uncle, but it does get you a number in your account that keeps growing whether anyone's impressed by it or not. So here's the practical plan. Before you buy anything, calculate your full monthly cost of ownership, not just the mortgage payment. Add taxes, insurance, and 1% for maintenance. Then compare that to your current rent for an equivalent space. Then check your local price-to-rent ratio using that simple math, factor in how long you'll actually stay, and be honest about which side of the "for savings" question you fall on. If buying wins for your situation and timeline, buy with confidence. If renting wins, rent with confidence and actually invest the full difference every single month, because that part is the one people skip. In the next 24 hours, pull up your city's average home price and average rent for a similar place, and run the price-to-rent number yourself. Then comment, "My ratio is X," so I can see what real numbers people are working with out there. Because the goal was never to prove your uncle wrong at Thanksgiving. It's knowing exactly why you made the decision you made, instead of guessing at 11:47 p.m. with your thumb hovering over a button.